The days of runaway inflation may finally be nearing an end in Britain. This week, all eyes are on the Bank of England as it weighs whether to take the first steps toward monetary easing after over a year of aggressive interest rate hikes aimed at wrestling consumer price growth back under control. For ordinary Britons, the stakes could hardly be higher. Household budgets have been squeezed dry by the toxic combination of stagnant wages and the highest inflation rates in 4 decades. The cost of essentials like food, energy, and housing has skyrocketed, leaving families in the lurch. An affordability crisis is gripping the nation. The good news is there are finally some glimmers of hope on the horizon. Headline inflation has started to slow, dropping to 10.1% in March from its double-digit peak. The question now is whether the Bank of England believes that progress is durable enough to begin cautiously pumping the brakes on its inflation-fighting campaign. The smart money says the central bank will stand pat this week, leaving its benchmark interest rate locked at 4.25%, but an increasing number of policymakers are making the case that Britain has turned a corner and it's time to start planning an off-ramp from the most aggressive tightening cycle in 3 decades before higher borrowing costs do permanent damage to the economy. The market is underestimating the push among MPC members to start cutting rates soon, Jens Larsen of Eurasia Group told me. The underlying data in the UK is quite weak. There is good reason for them to get on with it. Indeed, the vibrant debate within the 9-member Monetary Policy Committee highlights the challenging dynamics at play. 2 external members, Swati Dhingra and Megan Green, have already cast dissenting votes for lower rates, expressing concerns about the risks of going too far in containing inflation. They appear to have an unexpected ally in Governor Andrew Bailey himself. In a recent interview with the Financial Times, Mr. Bailey revealed he is losing patience with the central bank's uber-hawkish stance. He called recent signs that inflation is abating encouraging and said rate cuts were now in play. Those are hardly the words of someone settling in for a long siege against price pressures. Mr. Bailey is clearly attuned to the brutal economics facing British households. Family finances are being blasted from all sides by the combination of decade-high mortgage rates, soaring grocery bills, and a broader crisis of economic stagnation. Britain's descent into recession has been shockingly rapid and painful. The governor seems to recognize the limits of what monetary policy alone can achieve in this toxic environment. He has stressed that the central bank doesn't need to see inflation carved in half before pivoting to a more supportive policy stance. A credible downward trajectory, not a return to the 2% target, is sufficient for action. You need to have confidence that it's heading in that direction, Mr. Bailey said of inflation, in what was seen as a signal that the dial at the Bank of England may soon be shifting from panic mode to something a bit more measured. But not everyone is on board with easing up on the inflation fight just yet. The central bank's chief economist, Hu Pil, has cautioned against being too quick to declare victory. He and several other MPC members seem determined to maintain maximum policy restraint until inflation's retreat is more well established. Their reticence is understandable. After years of above-target inflation, followed by the pandemic and war-fueled price spiral that sent the cost of living into the stratosphere, central bankers are haunted by the risk that an early pivot could squander their hard-won gains in re-anchoring the public's inflation expectations. The broader backdrop only heightens their concerns. While the UK economy shares some similarities with its European peers, key differences from the United States bear watching. Britain may find it easier to return inflation to heel, given its struggles are less driven by excess demand than on the supply-side shocks battering the entire continent. But it's an open question whether the same dynamics that caused the Federal Reserve to repeatedly underestimate how sticky core inflationary pressures would prove are at play in the UK as well. Central banks' inflation models continue to behave erratically in this unique environment. So an abundance of caution at the Bank of England is warranted. But Mr. Bailey and company must also weigh the very real risks that policy missteps on the other end of the spectrum could deal the UK economy further damaging blows that take years to undo. After over 15 months of interest rate hikes that dragged the cost of borrowing to its highest levels since the Great Recession, Britain finds itself at a precarious crossroads. The inflation menace may have crested. But the nation's financial guardians must navigate a tricky path to restore price stability without crashing the economy. For ordinary Britons already making painful sacrifices to absorb rising costs, the stakes couldn't be higher for the central bank to get this inflection point right. The hope is that this week's policy deliberations mark the beginning of the end of this inflationary nightmare. A return to normalcy is sorely needed.